Hello everyone, myself Dr. Vinay Gandal from KMC College Khopoli. Today I am going to talk about investment accounting. Dear students, in this lecture we will see the introduction about investment accounting, its detailed accounting procedure. We will also see about various concepts of investment accounting like types of investment, calculation of interest. We will also see about effects of interest and the method of calculation of interest at cum interest as well as X interest. According to accounting standard number 13, there should be a proper recording of investment accounting. So normally AS-13 provides various provisions for the purpose of keeping up-to-date record of investment in the books of accounts. So each person or concerned person required to follow these provisions while maintaining investment accounting. So dear students, first of all, it is necessary for all of us to understand the concept of investment. Normally, investment is an asset or item acquired with the goal of generating income or appreciation. Means there are many persons, uh, like we may popularly known as investors in the society, who are making uh, various types of investments in shares, bonds, debentures, securities, or fixed deposit with banks. Same, there are many companies like manufacturing companies, trading companies, non-trading companies. If they are having a money, they are also making some expenditure towards the investments. So one company can make investment in another company. So whatever investment has been made by the companies or person in various investment instruments, so in that case the person who had made any investment are getting normally in interest called as return on investment. So in that case, whatever amount of money invested as an investment, the person need to keep up to date record of all the transactions which has been made about investment. And the appreciation refers to an increase in the value of an asset over a time. Normally, investment is always treated as an asset and which is created to acquire some appreciation or to increase the value of an asset. Okay. When individual purchases goods as an investment, the main intent is not to consume the goods but rather to use it in the future to create wealth. So normally investment is made to create wealth in future. Even investment, each person or company is always expect some future benefits. So normally expenditure are made on certain investment with a long term view to get some long term benefits in near future. So whatever investment made by the companies or person in various types of investment instruments, so record of all these transactions are to be recorded properly in the books of accounts, and person need to follow the accounting provisions as prescribed in accounting standard number 13. Okay, so now we are going to learn some basic concepts with relation to investment accounting. Even before knowing about investment accounting, it is must for all of us to understand these basic concepts which is mainly related with investment accounting. Okay, so first basic concept, that is about types of investment. So dear students, there are various types of investments are available nowadays. A person or company can make investment in term deposit, they can make investment in stocks, some people or person can make investment in gold, mutual fund. There are many government schemes, bonds and debentures, provident funds, okay, fixed deposits. So there are various types of investments are available nowadays in front of people. So normally company or person can make some expenditure towards investment in various types which are available in front of us, and proper record has been made with relation to whatever investment transaction has been made by the person. Okay, but for the purpose of investment accounting, there are main two types of investment, and now we are going to discuss about this. So first type of investment is known as fixed income bearing securities, means the securities which gives investors a fixed type of income. So in that case, we have to learn various types of fixed income bearing securities. So fixed income bearing securities consist of debentures. So we can make investment in debentures if we made certain amount of expenditure towards debenture. In that case, the debenture holders can get the fixed amount of interest as a return on their investment. So debenture is also called as fixed income bearing securities. The another type of securities that is called as a preference shares. In the case of investment in preference shares, the preference shareholders also get fixed rate of interest on their investment. So preference shares also called as fixed income bearing securities. Then third type, that is government securities. If we can make any investment in government securities, we can get the return on our investment as a fixed rate as a designed or prescribed by the government. And fourth type of fixed income bearing security is the bonds, means investment in government bonds, also called as a fixed income bearing securities. So dear students, this is the first type of investment which is called as fixed income bearing securities, means from these investment we can get fixed income on our investment. The second type of investment is called as variable income bearing securities, means rate of return on such type of investment is not fixed. It is always variable depending upon the profit situation of the concerned company. And in that case, the type of variable income bearing securities is equity shares, means whatever investment made by the person in equity shareholders are called as equity shareholders, and equity shareholders are getting dividend on their investment, but it is not at a fixed rate. So if profit is available, then they can get certain amount of dividend. If in the case of loss, equity shareholders cannot get any amount of dividend. Means return on investment in case of equity shares is a variable. It is not fixed. So investment in equity shareholders is also called as variable income bearing securities. So these are the two types of investments that persons or company can make some of the expenditures as an investment. Okay, now we have to consider another basic concept that is called as a interest. So dear students, interest means the extra amount or extra money paid or payable for borrowing some funds or if we can get some benefits from others, normally we may pay certain amount of money as a charges. So it is interest means the extra amount or charges paid in consideration of getting some benefits. So normally in the case of investment accounting, the calculation of interest is important, and while calculating interest on investment, there should be a proper procedure. So first of all, it is necessary for all of us to understand the procedure of charging or receiving interest in the case of investment accounting. Okay. So first of all, interest on investment is always calculated on the nominal value of the security. So normally face value is to be considered for the purpose of calculation of interest on securities or whatever securities, either fixed income bearing securities or variable income bearing securities. So keep it in your mind, interest is always calculated on face value of the securities. And the second concept with relation to interest is that accrual. So in the case of interest on investment, the interest on securities accrues on due date fixed in advance. So normally interest is accrued on each due date which is fixed by the investors and the company in advance. So it is must to consider the date of interest while calculating or keeping the detailed accounting of investments. And third concept with relation to interest is payment. It means interest is paid to the holder of the security on the due date irrespective of his actual period of holding. So normally while keeping up to date record of investment accounting, we have to calculate interest on investment as per the fixed rate on nominal value, and interest is always accrued on due dates in advance, and it is to be paid on the concerned date of interest. So these are the three sub concepts of interest that are must to be considered while maintaining investment accounting. Okay. The next concept of investment accounting is effect of date of transfer on accounting of interest. So while keeping the record of interest in the case of investment accounting, it may create some effects. So in that case, first of all, we have to consider the transfer of interest on due date. If a security is transferred on the exact date when interest is falls due, the entire interest up to that due date belongs to the seller. Okay. And second, that is transfer of interest on other date. In that case, if a security is transferred on any other date, the interest received the next due date by the purchaser is made up of, that is, first calculation is interest from the last due date up to the date of transfer is considered, and secondly interest after due date of transfer is also considered. So in the case of interest transfer on due date and interest transfer on other date, the separate provision is to be considered while keeping the records of interest on investment accounting. Okay. Third basic concept, that is effect of X interest and cum interest price on accounting. As earlier I told that there are two methods of charging interest on investment, that is investment with X interest and investment with cum interest. So in the case of X interest and cum interest price on investment, first of all, we have to consider the accrued interest. So normally when a security is purchased, interest accrued from the last due date up to the date of purchase need to be considered. Okay, and accrued interest is calculated. So whatever transaction has been made, either X interest or cum interest price, first of all, person need to calculate the interest from the last due date up to the date of purchase for the purpose of calculation of accrued interest. Okay. And second, if investment made at X interest, in that case, when a security is purchased on any day after the due date, the price may be either exclude or include such accrued interest. So in the case of X interest, if the price is only towards the cost and exclude the accrued interest, it is known as X interest price. Means X interest price means the price without interest, means amount of interest is not included in the price, means if interest is separated from the price, then the system is known as X interest price. And in that case, X interest price is to be calculated as X interest price is equal to cost of the investment. Okay, so in the case of X interest price on investment, normally we have to calculate interest as per the rates available by considering the last due date of transaction up to the date of transaction, and it is normally exclude the price. Third category, that is cum interest price on investment. In the case of cum interest, it is the price with interest, means the price which include the amount of interest is known as cum interest price. If the price is towards the cost as well as the accrued interest, it is known as cum interest price. Okay, so in the case of cum interest price, normally we have to deduct amount of interest to find out the cost of investment. So dear students, while keeping the record of investment in the books of accounts, normally these are the two methods of calculation of interest, that is X interest price and cum interest price. In short, in the case of X interest price, price is always separated from the interest. X interest means the price which excludes the interest, and cum interest price means the price which include the interest, and normally we have to deduct amount of interest from the price in the case of cum interest price on investment. Okay, next accounting concept, that is called as accrued interest. So in the case of investment accounting, normally we have to consider the date of transaction as well as date of interest due. So normally interest are always received or receivable or paid or payable either on quarterly, 6 monthly or yearly basis. Okay, so in the case of accrued interest, for the purpose of accounting, whether the price is cum interest or X interest, accrued interest is always calculated and entered in the column in the investment accounting. So accrued interest is to be calculated by considering the months from last due date of interest up to the date of transaction. And if there is any accrued interest, that is to be calculated, and it should be recorded properly in the income column of investment accounting. Okay. Next concept of investment accounting is brokerage on actual price. Normally, it is a common practice to paid brokerage on purchase or sale of securities. So, brokerage on purchase or sale of securities is normally calculated on the purchase or sales price. So in the case of purchase transaction, normally brokerage is added to the purchase cost. And in the case of sale transaction, normally brokerage is deducted from the sales price. So dear students, keep it in your mind, whatever percentage of brokerage is there, if brokerage is there, and if any purchase of investment has been taken place, then brokerage is calculated and it is to be added in the purchase price. And if any sale of investment is there, so brokerage is to be calculated at a prescribed rate and it is to be deducted from the sales price. Okay. Next concept, that is called as investment account. So normally in the case of fixed income bearing security or variable income bearing securities or whatever securities are there, a separate investment account is to be open for each type of investment. For example, if we have to make investment in shares or debentures, so we need to maintain separate investment account for equity shares as well as separate investment account for debentures. So as per the accounting standard number 13, separate investment account is to be open for separate type of investment. Okay. Now we have to understand some examples of X interest and cum interest price. Means we have to study how X interest price is calculated and how cum interest price is calculated. Also, we will learn about how to calculate cost price in the case of X interest as well as cum interest price. So let us see the example number 1. An example is that if XYZ buys 200 debentures of nominal value of rupees 100 each of ICICI Limited, number 1, at rupees 98 X interest on 1st March 2013, and number 2, at rupees 101 cum interest on 1st March 2013. Interest at the rate of 12% per annum to be paid half yearly on 30th June and 31st December. So dear students, in this example, 200 debentures are purchased at a nominal value of rupees 100 each. But it is purchased, there are two conditions. First case is 200 debentures of rupees 100 each is purchased at a 98x interest on 1st March, and second condition, 200 debentures of rupees 100 each is purchased at rupees 101 cum interest on 1st March. Rate of interest is 12% and interest is to be paid half yearly on 30th June and 31st December. Means due date for interest are 30th June and 31st December. Means while keeping the up-to-date record of investment accounting, we have to consider all these. Okay, like nature of investment, the price of cum interest as well as X interest, date of transaction, rate of interest as well as due date for interest. So in this example, first of all, we have to find out nominal value of the investment. So in both the cases, nominal value is same. So in this case, nominal value is to be calculated by considering 200 debentures of rupees 100 each. That is 200 multiplied by 100 is equal to 20,000. Means in the both the cases, means either at X interest or cum interest, nominal value is rupees 20,000. Means face value of investment is rupees 20,000. Okay. Secondly, we have to calculate accrued interest. Means first of all, we have to consider whether there is any accrued interest on investment or not. So in this case, transaction is taken place on 1st March 2030 in both the cases. Okay, and interest is due on 30th June and 31st December. So normally interest is calculated from the last due date up to the date of transaction. So in this example, date of transaction is 1st March and last date of transaction, date of interest is 31st December. Means we have to calculate accrued interest from 1st January to 1st March. So in this example, date of purchase is 1st March 2013. Okay, and accrued interest for 2 months, that is January and February, is to be calculated. So the interest calculation is equal to 20,000 as a nominal value, because interest is always calculated on nominal value. So 20,000 multiplied by 12%, that is the rate of interest, into 2 by 12, means we have to calculate here accrued interest for 2 months, that is for January and February, and the amount of interest is rupees 400. Got it? So in this example, accrued interest is rupees 400, and then we have to calculate the cost price at X interest price or cum interest price. So in the case of first case, that is X interest price at rupees 98. So in this case, price paid while purchasing the investment of 200 debentures of rupees 100 each at rupees 98 X interest, that is 20,000 into 98 upon 100. So the total price paid on purchase of investment is 19,600. Okay, and interest for 2 months, that is interest is calculated by considering the last due date up to the date of transaction. So date of transaction is 1st March and last due date is 31st December. Means from 1st January to 1st March there are 2 months. So 2 months calculation of interest is, that is 20,000 into 12% for 2 months. The amount of interest is 400. Okay, and the nominal value of that investment is rupees 20,000. Means in the case of investment purchased at X interest, cost price is, that is price paid 19,600 and nominal value is rupees 20,000 and interest is 400. Means in the case of X interest, price is always exclude the interest. So 19,000 is different amount and interest is different amount 400. So while keeping the proper record, we have to mention 20,000 as a nominal value in the nominal value column of investment account. We have to record 400 in the column of income of investment account and 19,600 in the column of capital or cost price of that particular investment. Okay, then we have to understand the cost price if investment sold at investment purchased at a cum interest. So second case, that is investment debentures purchased at rupees 101 come interest on 1st March 2013. In this case, price paid is equal to 20,000 into 101 divided by 100. So total amount of price paid is 20,200 because 200 debentures purchased at rupees 101 at a come interest, and come interest means price which include the interest. Secondly, interest for 2 months also calculated like this, 20,000 into 12% for 2 months. So the amount of interest is same 400 and nominal value is rupees 20,000, that is same in both the cases. So in this case, price paid means cost price or capital value of the investment is rupees 20,200 is separately shown in the capital column by considering 20,200 minus 400 because come interest means the price with interest. So we can deduct amount of interest from the price paid. So after deducting 400 from 20,200, we can get 19,800 as a cost price and is to be shown in the cost price or capital value column of investment account. And nominal value we have to shown 20,000 and 400 shown in the income column of investment account. So dear students, this is the main difference between calculation of interest, calculation of cost price at X interest and cum interest price on investment. Okay. Then we have to consider the accounting entries on investment accounting. So normally there are many transactions, means purchase of investment, sale of investment, recording of profit or loss are to be recorded in the books of account by preparing journal or passing journal entries. So the first transaction, that is called as a purchase at X interest price, the accounting entry will be investment account debit to interest account debit to bank account. So whatever amount of investment is there, we have to consider cost price, amount of interest, and in bank account we have to record cost price plus interest, because in the case of X interest, price is always separate from the interest. So price excludes the interest. So we have to pass such type of entries. Second transaction, that is purchase of investment at a cum interest price. So accounting entry will be investment account debit, interest account debit to bank account. But just mentioning the amount in the investment column, we have to calculate amount of investment as cost price minus interest. And even in bank column, we have to mention cost price minus interest. Okay. The third transaction, that is called sales at X interest price. If sale of investment has been made, then entry will be passed like this: bank account debit to investment account to interest account. Okay, so we have to consider price which is received plus interest, as well as capital value of the investment minus interest. Okay. Fourth transaction, that is about sale of investment at a cum interest price. If investment sold at a cum interest, we have to record entry like this: bank account debit to investment account to interest account. So whatever actual amount received, that is to be recorded in bank column, and capital price of investment minus interest is to be recorded in the column of investment account, and separately we have to record amount of interest in the interest column. Okay. Next transaction, that is profit on sales. If any sale of investment has been made at a profit, then entry will be passed like this: investment account debit to profit and loss account. And in the case of loss sale, we can pass reverse entry, that is profit and loss account debit to investment account. Next transaction, that is about interest received. So normally interest received always received on due dates. So entry will be passed like this bank account debit to interest account. Next transaction, that is about accrued interest at the year end. So dear students, normally at the time of closing of investment account, we have to consider the due date of interest and last date of transaction. So in that case, if there is any accrued interest, we have to calculate amount of accrued interest, and entry will be passed for recording accrued interest like accrued interest account debit to interest account. And next transaction we have to consider while closing investment account, that is amount of interest transferred. So for transferring interest amount, entry will be passed like interest account debit to profit and loss account. And last, at the time of closing of investment account, we have to record entry for valuation at year end. So entry will be passed like profit and loss account debit to investment account. Okay. So this is some accounting entries which are to be passed while maintaining investment account. Now we have to consider, or we have to learn about format for investment accounting. So dear students, normally as stated in accounting standard number 13, separate investment account is to be prepared for separate type of investment, and this is the common format. Means we have to mention investment account for the year ending. We have to mention name of the security like equity shares, debentures, government bonds, whatever securities we are having. Due dates for interest. So normally on whatever dates the person is receiving a interest, so due dates properly mention, and a proper interest should be recorded on a due dates only. So we have to consider this is the common format for recording all the transactions about investment accounting. It has a debit side as well as credit side. Debit side consists of date column, particulars, nominal value, income, that is interest column, and capital value, that is cost price. Even on credit side, it has a date column, particulars, nominal value, income column, that is for interest, and capital column, that is for cost price. Okay. So if company having any balance of investment, that is opening balance of investment, normally it is debited on investment account as a to balance brought down. Okay. And whatever investment purchased during the year, so date wise transaction is to be recorded in the investment account. If purchases made, then it should be recorded on debit side of investment account as a to purchase or to bank account. And if any sale of investment has been made, it should be credited to investment account. Okay. So in the case of any profit or loss on sale of investment, it should be properly recorded. So in the case of profit, whatever profit is there, that should be debited to investment account, and whatever loss is there, it should be credited to investment account. If there is any interest received or interest paid, it is properly recorded on debit side as well as credit side of investment account. And lastly, at the time of closing of investment account, whatever closing balance is there, that should be calculated, and shown on credit side of investment account, and if there is any accrued interest, it is also calculated and properly shown in the income column. Okay, so this is the simple chart which is to be used for recording up-to-date records of investment account. Okay, if you are having any difficulties about investment account and provisions with relation to AS-13, you can ask or comment. Thank you.